Hello, can you hear me? Please confirm you can hear me and you can see my screen.
Yes, we can.
Okay. So I was saying that in the last three classes, we've been this good morning class. Thank you for joining the class this morning. I hope we're fine. I hope we're good and all of that. And I hope that you're starting to realize that the exam is way, way, way closer than you think. Um, just for your knowledge, we have done this class for about 9 weeks. Yeah, we've done this class for about 9 weeks. We started the first week in January. So this is our 10th class, as the case may be. This is our 10th week, as the case may be. So just to tell you that class has been moving on. If you've not listened to the recordings that have been provided, there for you to start to take advantage of those recordings. That's why you have the advantage as an online student, right? Yeah, also to say that we're slowly rounding up my part of the course as well. So if you have not been following, you have a lot of work on your end to do. Okay, so in the last 3 weeks, we have been discussing ethics. We talked about the ethical theories, and then um, we moved on to talk about professional practice in our last class. So in this class, we're going to talk about conflict of interest. Now, just as a recap of last week, one of the things that we talked about were the fundamental principles. And for the benefit of those that were not in class, I would just do a quick review of them again. Okay, so we talked about so we talked about what the word profession means. We went on to talk about what it means as a professional to have a responsibility to the public, what it means to have a fiduciary responsibility to the public. We moved on to talk about the corporate code of ethics and the meaning of the corporate code of ethics. We said that it was a formal written statement. And we talked about the reasons why ethics are being implemented, and there are three of them: managing for compliance, managing stakeholders' relations, and entities striving to create a value-based organization. We moved on to talk about what code of ethics means for account potential that we implement this code of ethics. We also moved on to talk about the fundamental principle, and that's the reason why I'm even doing this revision. So it is from the IFAC Code of Ethics, which is the International Ethics Standard Board that ICAN adopted. And this is what governs how even us as professionals in Nigeria under ICAN act, because ICAN adopted this fundamental principle. And now there are about 5 of them: integrity, objectivity, professional competence and due care, confidentiality, and professional behavior. And in our last class, we had gone over them. Just to say that as an accountant, these are the principles that you're expected to act by when discharging your duties, right? You are supposed to be somebody that is objective, you're supposed to be somebody that has integrity, you are supposed to a large extent, not even a large extent, you're supposed to understand the scope of the work that has been given to you. And confidentiality is also very essential as well. Professional behavior just means that as a professional, you cannot be found acting in a way that discredits the profession. Okay, so that's professional behavior. So that was where we stopped last week, and this is why this week we're going to be continuing from conflict of interest. Now it looks, can you guys hear me?
Hear you.
I can hear you. Can you hear me?
I hear you.
Okay. It's because everywhere is quiet. I'm wondering if you guys are with me. Let me move this. I like to see everybody's name. So you may be thinking that see these fundamental principles, they are not hard now. Everybody should be able to follow it. What is there? Just have integrity, just understand confidentiality and all of that. But if you know anything about our profession, you know that it is a social science. And because it's a social science, it deals a lot with the interactions that we have with human beings, okay? Inevitable. Where two human beings existing, conflict is inevitable. And if you did ATS, we talk about communication skills, and we have different type of conflicts. Some conflicts are constructive. Just hey, and they say my internet is unstable. Can you guys hear me?
Yeah, it was a bit crack, but we can hear you.
Can you hear me now? Okay. I've told you, I don't know. Everybody has said that if a network after ends, then maybe we should just start doing fashion week or something. Well, okay. Okay, moving on. So we want to look at what are the circumstances that will arise that will not enable an accountant to be able to act in line with what are the circumstances that would arise that will not make it possible for an accountant to act in line with his conflict of interest, and how exactly does he resolve this conflict of interest? Okay, so now, ethical conflict of interest is known as ethical dilemma. Known as ethical dilemma is when ethical principles demand for opposite results in the same situation. In order to resolve an ethical conflict, a choice must be made by that a choice must be made that by definition will leave one of the ethical principles compromised. A key reason behind ethical conflict is conflict of interest between decisions. I mean, you have to remove this. Okay. Between taking decision in one's self-interest versus making decision in the best interest of clients. Oh, this one is long English. Conflict of interest is basically a situation whereby you are having other interests in a particular engagement apart from the interest that your client wants you to have from that engagement. Okay? So the client is just telling you that, okay, come and audit today, but the reason why you are going is because you also want to get contracts from that client. If you have any other interest in a particular entity apart from the work that they're engaging you to do, then there is a problem. Okay? What is now ethical conflict resolution? Ethical conflict resolution are situations that demand compromise on a fundamental principle, such that they are asking you to tweak what you regularly do to achieve a different result. And what will happen is that they will tell you that depending on how you look at it, it can either be right or wrong. We're going to look at illustrations of conflict resolution, and we're going to see situations where it arises. Okay. Now, moving on. Nature of ethical threats. Ethical threats are threats to compliance with the fundamental principle, and they are divided into 5. So the acronym for this is SAFI. The acronym for this is what? Is SAFI. Okay, SSAFI. Okay. SSAFI. So the first S means self-interest threat. The second S means self-review threat. The A means advocacy threat. And the F means intimidation. The F means familiarity threat, while the last A means intimidation threat. So what is self-review or conflict of interest? This occurs when the personal interest of a professional or a close family members are affected by the accountant decisions or action. So self-interest threat is, like I said, when there is personal interest in the work that you are engaging with the clients. You understand? You are having another advantage than just carrying out your professional work with your engagements with our clients. The second one we have is self-review threats. Self-review threat. This is a threat that occurs when a professional is responsible for reviewing work or a judgment that he was responsible for originally. An extreme example will be a situation where a professional accountant prepared the annual financial statements for a corporate client and then is appointed to do the audit. You cannot prepare the financial statement and be the one responsible for auditing that particular client. If you are the one that prepared the financial statement and you're auditing it, will you see anything that is wrong in that financial statement? No, right? And if we even look at it, what is the objective of the accountant? Is to put the company in a good light. What is the objective of an auditor? Is to make sure that the books are being prepared in line with the reporting framework. So you can see that there's already a conflict of interest in that context, you understand, which is even leading to a self-interest threat as well. So another example of like self-review threat is when an accountant was part of management decision in the previous accounting year, and then in this current year, he's now found to be auditing that same statement. Okay? Can you guys hear me?
Can hear you now.
Yes,
Okay.
but it's like you're far away from the mic.
I am not far away. See, my system is literally on my leg. I am speaking to the speaker. I don't know. I'm not far away. Is it better? Is it any different now?
Let's continue. We can hear you. We can hear you. Let's continue.
Is it like that for other people?
Yeah, it's the same way, but it's better.
Okay, my volume is on the highest. I'm doing everything. Okay. So, like I was saying, another example of like self-review threat is that you were part of you that made management decision in the previous accounting year, and this year you want to be part of the people that are auditing that management decision that you made. You understand? You were in the management board, you now move to auditing. The audit firm now wants to audit, they're not calling you to audit, so you're not going. Right? It is wrong because it's self-review. You are simply reviewing a work that you were a part of, and that will lead to self-review threat, which we will be seeing an element of self-interest in it. That they will not be saying that, oh, maybe when you the author will say, this particular thing is wrong, and then they will look at you and say, but you were there when we're doing it now. You know, that in itself is already a problem. Okay, so we have A, which is advocacy threat. This is the type of threat that occurs where an accountant promotes the point of view of a client, for example, acting as a professional witness in a legal dispute. Acting as an advocate for the client can reach the point where objectivity of the accountant is being compromised. I always use that as an example. In everything that you saw companies trying to do last year to raise shares, did you see KPMG coming out to say, oh, we've audited these people before. It's a very good company. You should buy shares from them. Did you see any of the big fours coming to do that? Did you see any of the big fours advocating for any of the banks to help them raise shares?
No.
Okay. So that's just to tell you that it's because it will breach their advocacy. Okay? It's because it will breach their what? Advocacy. They cannot be found. You cannot be found. Imagine that as an audit firm, you are now, imagine that as an audit firm, you are now being found promoting a client. You're now going to court. My lord, my client cannot lie. This my client is a very good, what would the judge start to tell you that? Is there something he needs for you apart from just being this person's right auditor or being their tax consultant? Then we have familiarity traits. A familiarity trait arises from knowing somebody very well through a long association in business. The risk is that an accountant might become too familiar with the client and therefore become more sympathetic to the clients and more willing to accept the client's point of view. And this is like the justification. People that are doing audit and assurance This is justification for audit rotation, right? Where they'll say that when you have audited the client for a minimum amount of years, that's supposed to shuffle it again for another person to also audit that client. Because we are human beings. Even some of you go somewhere and in 1 week you have had a best friend. Do you understand? And in 1 week you have had a best friend. How much more? Imagine auditing a client for 5 years, 7 years. Some people even go as much as 10 years. You want to tell me that after auditing a client for 10 years, then you guys will now say that you don't have any familiarity? Oh, no, we still just, to get to a point, to have, you will now go, you buy Shelby, you buy gift. Because you have attended the zone, you say that didn't mean share my burial, you two, you will now go. We're familiar with all these things, right? And so can we say that after having that kind of interaction with a client for over 5 years, 7 years, you are still saying that you are exerting the same level of professional competence like you will be exerting? Is that possible?
It's
Somebody wants to say it's possible. Is it possible? Nobody's talking to me. Oh.
I said no, it's not possible.
Okay, okay. So you can you can think about it and say, oh. Okay. Moving on, we also have the last one, which is intimidation threats. Now, I always say that intimidation threats comes from having intimidation threats occurs where there is a duty of trust. Okay, intimidation threats comes where there is a duty of trust. Now, how is there a duty of trust? So, for you to be intimidated by somebody, it means that you have placed that person on a certain pedestal. Okay, so because somebody that you not send cannot intimidate you. So let's read what it means. A professional accountant might find that his objectivity and independence is threatened, is threatened by intimidation, either real intimidation or imagined intimidation. This threat to compliance with fundamental principles apply to firms of accountants in their dealings with clients as well as to individual accountants. So they just wanted to summarize that. So intimidation threats comes from somebody that you trust or somebody that you have placed on a certain reference, instigating for you to breach your fundamental principle. Example, we can read an exam question and they tell you that you are a junior accountant. The senior accountant of your company has told you that, oh, we need to change figure so that this thing will balance and all of that. And you know that this person has been an accountant well over 20 years. They've risen to CFO in your organization. You get. So because of the, in quote and unquote, the kind of reference that you have given to that particular person that you trust, you know, even if he doesn't tell you that, oh, what I mean is that you should go and change figure, it is an imagined intimidation. This person has told me what to do. I cannot say I will not do it. Or sometimes it can even be real. Situations whereby they threaten your job, they threaten to sue you if you don't do a certain thing, they threaten not to promote you. You understand? All those ones are actual real intimidation. This explains the rule that we have about independence, where they say that you should not be getting 25% of your total income from one client, because there's no how that one client is giving you 25% of your total income and that client is not top rating. If that client asks you to do something, you will not do it. Imagine you're making 100 million a year and one client is giving you 25 million. If the client say, what we want this year is to our head to turn like this, you know, you're starting to think about it that I really need this money. If I just secure these clients, one of my quarter goal is met already. You understand? What they tell you that don't put yourself in a position whereby you are somebody's mercy. That's it. You understand? So that is intimidation threats for us. Okay. So do we understand all the 5 threats? Safely? You go somewhere and somebody tells you that explain all the ethical threats for me. Can you explain it for them? Confirm to me.
Yes.
Yes.
Okay. Okay. So moving on. Now, you now think about it. Okay.
Please, can you see enlighten us on this intimidation thread? I didn't really get it. Sorry.
So intimidation threat comes from a duty of trust. Comes from intimidation threats comes where there is a presence of trust, right? It is a situation whereby an accountant is being threatened by intimidation. The intimidation can either be real. The intimidation can either be real or be imagined. So if they're telling you that they will actually sue you, they will do something, and all of that, that is a real intimidation. We're going to sue you, we're going to demote you, we want you to change figure, you say no. Oh, we want you to help us to falsify records, you say no. We want you to help us to sign off a report that is not actually what happened in the entity, you say no. We want you to give us a unmodified statement, just say that, our company is good to go, and you do not agree. That in itself is a problem. Okay? So that is intimidation. Do you understand that now? And I said that it can come from your interactions with your actual line managers, or it can come from a client. How can it come from interaction with your line managers? It comes when it's somebody that you trust that's asking you to do this, that's asking you to breach your fundamental principle. And how can it come from a client when that client has such a high rating that you know that you cannot go against what the client wants? You are going to always do what the client wants you to. You understand? That one is an intimidation that can come when you are dealing with clients. Okay?
Okay.
So yeah, somebody is asking that, okay, so now when all this threat have happened, what does the accountant do? What can you do? What can you do to manage this situation? Quote and unquote, right?
Your voice is fluctuating.
Okay, Ms. Aisha, but to be honest, I am standing in the same position. I have not moved. Is it better now?
Yes, it's much better now.
Yes, to be honest, I think it's the network because I literally have no moved. Okay, so somebody is asking now, okay, so what should the accountant do in this context? Are we just going to stand and watch, or what are we supposed to do? And this is where we talk about when there is threat to compliance with fundamental principles. The accountant should assess when there's threat to compliance with fundamental principles. The accountant should assess the safeguard against the threat. They might already be safeguards in place. There might already be safeguards in place. There might already be safeguards in place that eliminate the possibility that risks will ever materialize, or that reduces the risk on an acceptable level. So in your CSME, your risk, you're talking about residual risks, which is or efforts that are being made to reduce the risk to an acceptable level. So if the safeguards that exist are not sufficient, accountants should try new safeguards to eliminate or reduce the risks to an insignificant level. So long and short, when all these threats materialize, the solution is to try and reduce the risk to a significant level. Okay? Is to try and reduce the risk to a significant level. Now, safeguards are now divided into two broad categories. This safeguard that we're using, but just think about threats being an open wound, right? Safeguards are what you are putting in place to manage that injury, not so that it does not escalate, right? So there are two types of safeguards. We have safeguards that are created externally, which is by government legislations or regulations, or the ones that the accounting profession in itself has put in place to protect accountants from when this risk materializes. And then the second one we have are safeguards that are established within the work environment. So every audit firm or every accounting firm is also supposed to like or put in place safeguards to shield its staff members from these threats. Okay. So we're going to look at them one by one. The safeguards that have been created by the regulation or the accounting profession, and we'll look at the safeguards that have been implemented in the work environment. Okay, so I'll just highlight them. Okay, so somebody can read for us safeguards that are created by legislation. I'm with you. Who's reading for us? So, if you want me to call name, person's name have I no head. Good morning, Judith. I'm not sure I've heard your voice before.
Good morning, ma'am. I'm on the move. I'm sorry, but I can manage. Just that here is a bit noisy.
Okay. Okay. Anybody wants to help her?
Right. Did I go ahead?
Oh, what did you say? You said you cannot mute.
I said I'm on the move, but I can manage. Here is a bit noisy.
Okay. That's what I was saying. Like
Yes,
somebody
ma'am.
can help you so that you're not uncomfortable. Yeah, that's what I was saying. So just it's fine. Just mute yourself so that we don't. Yeah. Okay. Isioma is our show reader. Isioma, you were supposed to. You said you were going to send me a message. I think she has dropped off. Okay. Any other person? Augusta, can you unmute and read the safeguard created by legislation for us? Hello, who can just unmute and read for us now so that we can move on, please?
Let me just read.
Okay.
Safeguards created by legislation, regulation, or the accountancy profession. Safeguards that are created externally by legislation, regulation, or the profession include the following: the requirement for individuals to have education and training and work experience as a precondition for membership of the professional body. The continuing professional development, CPD requirements for qualified members to ensure that they maintain a suitable level of competence. Corporate governance regulations, particularly those relating to auditing, financial reporting, and internal control. Professional standards, such as financial reporting standards and auditing standards. Monitoring procedures and disciplinary procedures, and external review by a legally empowered third party.
Okay. Thank you very, very much. So thank you very much, Miriam. So this one is just basically saying that, okay, what has ICAN, what has the government, and what has the accounting profession put in place to basically protect accountants from these threats? And the first one is, before, even after you have taken on your ICAN exam, before you are allowed to be a registered member of ICAN, you must have either 48 months experience or 36 months experience practicing, your job. This is just one of the protections that have been put in place for accountants. So the educational training that you're getting now is a part of it, and also the work experience that is required for you to now be verified as a member a form of they are both a form of protection for accountants. The second one we have is the continuing professional development, CPD, which is a requirement for all qualified members. So all qualified members are expected to take on other courses. If you go to ICAN page, you see that, they have all these short courses that they usually take. Or they can do a course on risk management, they can do a course on ethics. You see 150K, 100K, and in global entities, they treat these courses as a learning and development, right? That is being funded by the company, their staff members. Okay, so that is all our continuing professional development are also efforts that's been put in place by the legislature or that's been put by the accounting profession in itself. The third one we have is all our corporate governance regulations, the ones that are related to audits, that they said that, okay, we want to have an audit committee, the shareholders of the one must be the ones to appoint the auditors. All our corporate governance code that have been created relating directly to audits, financial reporting, and internal control are also a form of protection for accountants, just basically making sure that one, power is not concentrated in a particular office. Imagine if the directors are the ones that are appointing you and they can sack you. But now shareholders also have some level of power. Even in the audit committee, a shareholder is the head of that committee, even if directors are there. You understand? Even if we said that they won't change it to non-executive directors, that means they don't want executive directors anymore. Three shareholders and soon non-executive directors. So you can see that it's basically dilution of power, on the end of those people that are responsible for managing the entity on a day-to-day basis, which are the executive directors. We have the fourth one, which is all our professional standards. Somebody will think about it, that wow, these standards just a lot and everything. These standards are put in place to shield you. So imagine if you go somewhere and this person saying that there's no money we're expecting, we're not gotten the money, or we've put it in our assets. And then you're like, no, assets is something that you already have, is owned by you, is a resource, is something that is in your control. You have ownership of. This is what the standards say. So those standards are things that help us to make sure that we are acting in line with what is supposed to be, not what our client thinks should be done. And then we have the last one, which is external review by a legally empowered third party. So you would have heard about reviews. Reviews are other forms of assurance engagement that are not necessarily audits, right? And we have different kind of reviews, peer reviews, all of that. But at intervals, financial statements that are being audited are being reviewed by another party to confirm that the process that has been done is accurate, with what the standard requires. So those are 6 of the safeguards that ICAN has put in place. ICAN, the accounting profession in itself, legislation has put in place to protect the accountants from all these risks materializing. Now, let's look at safeguards in the work environment. This one is every accounting firm, like I was saying, every accounting firm, every assurance firm, they're supposed to put in place laws to protect, right? To protect staff members. The first one we have is that they must make sure that these safeguards are applied across all the organization. Some people should not be able to use these safeguards and other people cannot access the safeguards. Okay. The second thing is that there must be safeguards. Okay, they said they divide into categories. Safeguards that apply to the entire firm, safeguards that apply to a specific item in the work, safeguards. Okay, so they divide into 2. Let me just highlight so that we're not confused. So what are the safeguards that apply to the whole firm for me? This is the first time I'm seeing them separated, but okay. So safeguards in the work environment. So they're divided into 2. The first one is safeguards for the whole firm, and the second one is safeguards for a particular work. So what are the safeguards that apply to the whole firm? Number 1 is the code of ethics. That statement that shows that as an entity, they are committed to applying the relevant code of ethics in order to get the work done. Is very, very essential. The second one is a sound system of internal control. An entity must make sure that as an organization, they have putting in all effort to make sure that their internal control is sound. The third one we have is the application of appropriate policies and procedures for monitoring the quality of work done for clients. There should be a outlined procedure that, okay, this is the quality of work that we do. And on all jobs that we received, all these procedures must have been checklists that they were done. The next one we have is policies that limit reliance on the firm on the income fee from a single client. So they should also have a commitment that, yes, this thing that we're saying that you must not get a chunk of your audit fee from one client because it puts you at a position where you are not able to exercise your duties well. You understand? should be taken very seriously. And then we have procedures for identifying personal interest and family relation between employees and partners of the firm and key staff in client organization. I don't know, you can correct me if I'm wrong, but if anybody here works with the Big Four, they will tell that when they have an engagement, they send a risk form. In that risk form, you are supposed to select if you have any relationship with the clients, if you know anybody there, if you have any relationship with that client, and you're thinking that, okay, I don't want to audit this client, I don't want to be in the audit of this client, you can also fill it in that risk form so that they will consider the people that they are putting on that particular engagement. So you can see that is a safeguard that entity has put in place. Then we have whistleblowing procedures for reporting illegal or unethical behavior. Whistleblowing procedures for reporting illegal or unethical behavior. So you, as an organization, you should also have procedures where people can report certain things. Then people can say, okay, this thing this is what's going on, even anonymously, to protect their interest as well when all of this is being done. So whistleblowing procedures are very, very important. Okay, so those are the safeguards that are implemented throughout the firm. Now, when it comes to every engagement that we have, some safeguards are also supposed to be put in place. The first one is that you're supposed to keep individuals away from work that will threaten their compliance. It's very bad that you know that this person was part of the management team of this particular entity in the previous financial year, and you are putting the person on that engagement. What exactly do you want, okay, from that particular individual? So keep individuals from audit work or accounting work that will threaten their independence. The second one is that in the case of audit firms, it's very important for us to rotate audit partners on the engagement. After a partner has been there for a maximum amount of years, can be 5 years. Some people do 3 years, can be 3 to 5 years. Some people stretch 7 years, but I think the rule is about 5 years. So when they've been there for a maximum amount of years, they should be changed just so that you are avoiding familiarity on that particular engagement. And then we have the application of strong internal control on that engagement. So while the entity is putting in place the internal control, they should make sure that efforts are also made to apply the right internal control. And then we have using another accountant to review the work that has been done by a colleague. So this one is just, I think they call it call over, right? If I've done a work, we can also give that work to Alexa and say, Alexa, this is the work that someone has done. Review it to make sure that it is good to go and all of that. Then we said discussing ethical issues with people in the company who are responsible for governance. Example, your audit committee, your non-executive directors, your board of directors, right? So you discuss ethical issues that are arising with people that are able to sit and make decisions about them. Okay? So those are the 2 levels of safeguard we have. Safeguard by the legislation, regulation, and accounting profession, and safeguard in the work environment. The work environment is now divided into safeguard across the whole firm and safeguards for a particular engagement. Okay? Now, most of the time, when you have questions on threats and safeguard, they come in a case study format. Are you with me? Most of the time when you have on safeguards and threats, they come in a case study format. So how do they come in a case study format? You basically be giving a breakdown of questions, right? Be giving a breakdown of questions, and they will now tell you that this is the facts, right? We want you to identify what the fundamental principles are. We want you to identify based on this model. You guys are doing models now. So based on this case study that has been given to you, identify the threats that have arisen, right? And then the third one will now be advice on the safeguards. Advice on the safeguards to be implemented. to help this entity. Advice on the safeguards to be implemented to help this entity not to breach their fundamental principles. Okay, so that is typically how the questions will come. So that's why they called it a model for resolving ethical conflicts. Can you guys still hear me?
Yes.
Yes.
So that's why they called it a model for resolving. That's why they called it a model for resolving what? Ethical conflicts. So let's just read. ICAN has suggested a model for dealing with ethical conflicts and using judgment to decide how conflict should be resolved. It is based on recognizing threats to compliance with fundamental principles and assessing safeguards to eliminate the threats. The model has several logical stages. So there are about how many stages now? There are about 6 stages. So they are saying that in every instance, you'll be given a model and you have to apply this ethical resolving conflicts to solve the model, okay? So what is the stage 1 of this model? You have to recognize and define the ethical issues involved in this particular case. So we said accountants are expected to identify potential threats to their compliance with fundamental principles. To do this, they must be able to recognize the ethical issues that exist or that may possibly exist. The first step is to define the issue. In order to do this, it might be necessary to establish the facts. All this one is plenty English. They're basically saying that when they give you the question, you want to, maybe they say, Aisha is a young accountant of Idiagbon PLC. She works with her manager called Mr. Lukman. Abi, Mr. Lukman is also a chartered accountant with 15 years experience. Are you with me? Outline the ethical or the fundamental principles to be followed by chartered accountants. So you know that both of them are chartered accountants. You can just go on to list all the fundamental principles that should apply to both of them. The second thing, identify the threats to compliance. They will now continue the story. Mr. Lukman has asked Aisha to compromise on or to do creative accounting on the records from last year, as the shareholders want a 30% increase in profit from the last year's financial statement. You understand? So based off of what they've told you, you're supposed to identify the threats that will affect compliance with fundamental principles. So we're seeing an intimidation threat, right? We're seeing a self-interest threat, and he has promised that she will be promoted the moment she does this. You understand? We're seeing a self-interest threat. We're seeing an intimidation threat. Okay? But even maybe they say that Mr. Lukman invited Aisha to a lunch to discuss. We are seeing a familiarity threat because it is because of a certain relationship that conversation is coming out. Okay? So that's the next thing you're supposed to do. You look at the question and identify where the threat is coming from. So they wrote here, having established the facts and defined the ethical issues, the accountant must think about his own involvement. The concern of the accountant should be whether his compliance with the fundamental principle is under threat. And if so, what is the nature of the threat? Is it self-interest? Is it self-review? Is it an advocacy threat? Is it a familiarity threat? Or is it a threat from intimidation? And how does this threaten his ability to be able to comply with the requirements of integrity, objectivity, professional competence, and due care? So basically saying that what are the things that are going wrong in this request that has come to me? Do I want to reach out? Do I want to check the provisions that have been made for me according to the accounting profession that I can exploit? Or do I want to check somebody in my work environment about this? Do we have internal control procedures that we can use to solve this? Can I tell the person that this is a standard person and I cannot do that? You understand? Can I report the person to another person that is not easy? CFO. Can you guys hear me?
Yes.
Yes. Hello, can you hear me? Okay. So even if it's the financial officer in that organization, okay? Okay. So you want to now check that what are the level of safeguard that I can apply in this case. The fifth one we have is that it should now reassess the threat to compliance after he has put additional safeguard. Does he need to add additional safeguard again? Or what exactly does he want? So they said that if you put small solution and it's not working, put another solution again. So in this case, for example, the CFO, if you are reported to executive directors and you realize that executive directors gone are the ones that are even telling the CFO what to do, you want to consider taking the matter to the board, telling the board that, okay, this is what's happening, this is what they're telling me to do, and I don't want to do it. You understand? So that is it. Also, that's him just saying that does he want to apply additional safeguard than what he already has. Then the last one is make the decision on what to do. In the end, he has to make up his mind that this is what I want to do, okay, about this particular matter. So moving on, we have the, just go over the past questions. From here, I can see that it has been asked about 3 times. So just quickly look at it. We have, what's this diet now? November 2018 question 5, November 2015, and November 2019 question. So let's just check November 2018 question 5. So it is not a one-size-fits-all case study. You know, the questions will always evolve, and your answer will be based on what has been provided for you. You know, the same way you answer your models in management. That's the same way you answer this. Yeah. So you said you have been invited to facilitate a session on how to deal with. You have been invited to facilitate a session on how to deal with ethical conflicts. Then they said you have been asked to facilitate a session on how to deal with ethical conflict. Discuss the 6 stages. So let me just go over it again. The 6 stages. Number 1, you identify, recognize and define the ethical issues. Number 2, you identify the threat to compliance. Number 3, you assess the significance of the threat. You assess the significance of the threat. Number 4, if the threats are not significant, you want to consider putting safeguards. Now, stage 5, you reassess the threats after your safeguards and check whether safeguards have eliminated the risks or if it has reduced it to a significant level. And then in stage 6, you make up your mind on what you want. So I think the next diet was the early one. So just go back to the beginning. They said identify and discuss the ethical issues involved in the above scenario. Okay. So there's a question. Can somebody read for us? Let's read it. Roy Company. What are the ethical issues involved? Hi, Miriam. Can you read for us? So I won't take too much time. Let's just go to.
We should read the question.
Yes.
Roy Company PLC manufactures aluminium, that is stainless, household equipment. Its plant is located by Alobi River, which is a source of water for the community. The company currently has the largest share of the market on the West African coast and plans to expand its operation to the East African and South African markets. At the 26th Annual General Meeting, shareholders approved the appointment of Adiola and Partners as external auditors to the company. The managing partner of Adiola and Partners, Sir Segun Adiola, is a nephew of the managing director of Roy Company PLC. The appointment of Adiola and Partners as external auditors to Roy Company was facilitated by the managing director, who had not disclosed his relationship with Sir Segun Adiola to the company's board. At the recent board meeting, the managing director of Roy expressed concern that so much resources were expended towards satisfying the interests of the community at the expense of the company's shareholders. According to him, shareholders are the priority. He further opined that although other shareholders are important to the company, but only to the extent that Roy needs them. Consequently, the board resolved that henceforth the company should not spend more than 0.5% of its profits after tax on other shareholders. At the peak of the company's production cycle, one of its underwater waste tanks ruptured and a large quantity of the chemical waste leaked into Alobi River. This led to the destruction of aquatic life and contamination of neighboring farmlands. This catastrophe event devastated the community as many farmers and fishermen lost their sources of livelihood. The community's major source of drinking water was also contaminated. Scroll up. Is that all? Okay. The leadership of Alobe River Community Association. Yeah. Association approached the management of Roy Company PLC and requested them to pay huge sums as compensation to the affected people and also to construct 10 boreholes for the community. The management, however, informed the community leaders that based on its resolution of their board, expenditure on the issue should be limited to only 0.5% of profit after tax at the end of the year, which was projected to be far less than the amount of compensation demanded by the community. As a result, all discussion with the leadership of the community broke down. The youth of the community responded with a sit-in protest, leading to a blockade of the company's gate and disruption of its operation. The board of the company is now seeking immediate and amicable resolution of this problem. While this was going on, the company suffered a major fire outbreak in its second factory, destroying its main furnace, machines, and large quantity of its finished goods. Some of the workers were severely burnt. While attempting to put out the fire at the factory's major warehouse, this event culminated in production shutdown at the second factory and temporary disengagement of several skilled workers as well as some casual staff. Fortunately, the company is covered by comprehensive fire and workers' compensation insurance policy, which Nagode Risk and Life Assurance PLC.
Thank you very much. So you can see that this question is more about risks, strategic risks. That's even true. We have done risks in this class now. So can somebody tell me the risks that they can cite? Is a reputation risk, is a strategic risk, Abi? There is a business probity risk, they're not acting in an ethical manner. You have destroyed lives, and then you are now saying that you don't want to give them more than 0.5% of the profit. So yeah, so majority of that question. So using the stakeholders theory, and high interest, Abi, Mendelo's framework. So they said evaluate the company's residual risks. Can you guys hear me? Evaluate the company's residual risk. That's the risk that is remaining even after they've made effort to reduce the risks. So even after they've given 0.5% of their profits, how exactly are they supposed to solve the aggression from the youth and the ones from the fire? How can they manage the situation too as well? So the part we're looking at here is just the ethical issue. It's just one line. I've already highlighted it. They said discuss the ethical issues involved in the scenario. And the ethical issues that are involved here is there's a familiarity threat. Abi, the managing director of the employee an external auditor, that's his nephew. And what we are realizing here is that he did not tell the board. It's even not bad to say, okay, this is what's happening, but okay, I'm informing you guys so that you guys know that, okay, I'm related to this person and all of that. But you're not telling the board. So you not telling the board is even an indicator of you wanting to connive with somebody. You understand? So that's basically the ethical issue. If every other thing is related to risks. Okay. So yeah, let's just check the last one. I think we have May 2015 question 3 and question 6B. So let me just go there. That's the next diet. So when we're looking at it now, how do I know the right one to write for which? It's actually through practice. I always say it, even me that I'm teaching you, nobody brought the knowledge from heaven. It is your experience with past questions, how you interact with them, that when you go into an exam hall and you're seeing the question, you know that, okay, this is what I'm supposed to write. The ball is in your court. Okay. So May 2015, second question 3. It's also a case study, question 3, and let's just check 6D. They said, explain 4 situations in which an accountant might face a moral or ethical dilemma. Explain 4 situations in which an accountant may face a moral or ethical dilemma. See this one, they said it differentiates between a business code of ethics and professional code of ethics. We did that one last week. So that's a situation that you may face. You want to look at, there are different situations, a lot of situations. Let me even check if they went through threats. Yeah, as I said, threats, they outlined all the threats. Self-interest threats, self-review, intimidation. That's what they did. That's what they did. But like I said, you know, they've not asked you that what are the threats. They said mention on the situation in which an accountant may have ethical dilemma. Somebody will say, but they did not tell me that it was threats. Now, if I opened this question before now, you would have known that, okay, this is what they wanted to write in this particular question. So that's why I will always and always and always be an advocate for practicing past questions. It's not like you don't know it. You have heard it in class. Somebody has said it to you. It's for you to intentionally practice past questions. Okay? So let's go back to our number 3 question. That was a case study. Please, can somebody else that is not Miriam read, or do we just connect it? If nobody says anything, we won't treat this question, and I'll call it a day.
Okay, so let me read.
Okay.
You are a sole practitioner in public practice and you have taken on 3 new engagements. One is to prepare the annual account of AZ Trading Partners, a small business partnership with 2 partners, and the other 2 are to assist with the tax affair of the 2 individual partners. After taking up the engagement, you are told that the partners of AZ Trading Partners have now agreed to dissolve the partnership. One partner plans to retire and the other will take over the entire business and run it as a sole trader business. The partners of AZ Trading Partners have discussed how the asset of the business should be transferred to the partner who will remain as the owner. You are informed that the partners have privately agreed on an amount for the value of the goodwill of the business, and the retiring partner will receive 50% of this agreed goodwill value plus the return of his balance sheet capital. You are aware that in the balance sheet of AZ Trading Partners, the main asset is a warehouse building, which is valued at cost at 12 million. You do not have a current valuation, but you estimate that this warehouse could have a current market value in excess of 25 million. You do not know whether the retiring partner is aware of this, and you are concerned that the agreed value for business goodwill might therefore be too low. It has also not escaped your notice that the bookkeeper for the partnership business is the husband of the partner who is remaining in the business. Required. Consider whether or not there's an ethical issue in this situation and whether you have a duty to bring the value of the warehouse to the attention of the retiring partner. Suggest what you should do, if anything.
Wow, an exciting question. So what do we think? What do we think? First of all, what are the ethical issues involved here? We're seeing the familiarity traits, right?
Yes, ma'am.
Yes.
Are we seeing the familiarity traits or not?
Yes, there is.
So, okay, are we seeing a self-interest trait?
Yes, there is too.
What's the self-interest trait in this case?
Ah, being the wife of a partner in the business that still wants to retain the property, I believe both familiarity and even self-interest are all lumped up together on one side.
Hmm. Okay. So in this case, you're going to use that your ethical conflict resolution to answer the question. The first thing is that you identify the ethical issues that involve this question. As a professional, you should have integrity, objectivity, professional competence and due care, professional behavior and confidentiality. You will now discuss that, okay, in this case, what are the ethical issues that are being threatened, right? um does he have a duty of confidentiality to just one of the partners or to the whole business, right? um is he being a person of integrity, right? Is he being fair in his dealing? He also wants to consider if his behavior is professional enough. He doesn't want to disclose information in an absurd manner. He wants to get his facts right. Like he said, he does not really know about how much the building is. He has an estimate. So is he going to engage third party and have a proper evaluation of the building, you understand, before he now comes to say, okay, I've gotten my facts right and I think that these people are really doing something that is wrong. The moment he does that, he will now want to identify that, okay, what are the threats that are involved, like the ones that were listed. There's an intimidation, there's a familiarity threat, there's a self-interest, right? And this can also be an intimidation threat, because if he tells the retiring partner that all this was going on, there's a high chance that even if they continue the business, they will not want him to be their auditor, abi, to be their tax practitioner. Do you understand? So is he looking at it that there's an interest for me here, and I don't want to let it go? Should I just keep quiet? Maybe they will give the money back into the business, and if the money is back into the business, it's for all of us. Do you understand? To continue to use. So those are kind of things that you will engage. Then you not tell him that, okay, what are the safeguards that you can put in place? You know, like I said, he has to look for a way to engage evaluator to know the actual amount of the warehouse, to see if, you know, the right amount is being hired. And you also want to tell the retiring partner about the relationship that exists between the bookkeeper and the partner that is not living, you understand, so that he establishes all of that. But you know that there are also um, rules about confidentiality. So he has to look for a way, you know, maybe does he want to talk to experienced people in his firm, you know, to help him to go about this particular matter and how exactly to solve it. So, like I always say, carry yourself. Nobody will beat you. Question 3, go to the answer. And, you know, because it's ICAN, they will not bring out this question in the exact same context. You understand? So they say you should identify the ethical issues, um, identify if he has a duty. Like I said, does he have a duty to one partner, or does he have a duty to all the other partner? And what are the suggestions that he wants to make to the full party, the two of them together? So it's a case study, and your answer does not have to be the exact way it has been put here. You know that ICAN reaches out to ICAN centers to provide solutions to exam. So because this is how the answer was in the back, does not mean that every other student writes the exact way the answer has been written down was wrong. You get, it's just for you to understand what has been asked of you in that question and be able to respond to that question appropriately. Okay? Okay. So yes, we can also check all the times that this has been asked, so that we're able to update our knowledge, okay, on the Pathfinder. Okay, because I know that this is November 2021. We're obviously in 2025 already, so we would have had new questions. Okay, so yeah, that's it. Oh, straight and direct. Do we have questions?